When you think of famous investors, Warren Buffett always comes to mind. He's known for buying businesses that are really good quality and holding them for an extended amount of time. In today's video, we're going to be looking at 6 dividend stocks that he does hold. That makes up 78.4% of his portfolio, which we know the portfolio is $370 billion, which is kind of incredible to think. Now, when we look a couple years back at 2016, Apple wasn't doing too well. They didn't know if the growth had kind of plateaued. Price to earnings ratio was around 10 to 14% for the year. Overall, there was a lot of negative sentiment when it surrounded the company, which meant that it was time for Berkshire Hathaway and Warren Buffett to go ahead and buy a good stake in Apple. Now, if you look over the last 6 months, now the Apple is performing and owns almost 15% of the S&P 500, which is massive. Even though Apple's stock is down a little bit, there's been a sell-off on March 1st. The S&P went down with Apple because it does control so much of that. But overall, when we look at the equity positions within these companies, you think of Bank of America. Heavily invested in Bank of America always pays a very good dividend. American Express, Coca-Cola, Chevron, even looking at the Occidental Petroleum, I think that's how you say it. All of these are trading at a big discount on the S&P 500. When you combine this with Apple, this makes up that 78.4% of Berkshire Hathaway's portfolio. So let's consider them in terms of companies with the long term. Now, of course, when you think of the names that I just talked about, it is about the brand power. We talked about this for a while. When you started looking at companies, Warren Buffett has always said, invest in companies you use. So what we mean by that, if you have a Verizon phone or if you use Verizon services, own Verizon. If you use AT&T, if you use Xfinity, if you use Comcast, owning those companies. If you shop at Target, if you shop at Walmart, owning a little bit of those companies, you're really intertwining what you're doing on a daily basis and where you're spending your income along with millions of other people in the United States, meaning that if you're holding a part of that company, not only can you be part of the growth of that company, but you can also get dividends from that company itself. This is a really big thing that Warren Buffett focused on, was when you're looking at companies that are decent or doing well, you have to make sure what you're breaking down and what you're buying is going to be there. Now, of course, this is going to be really big. Now, Warren Buffett did learn a lot from Charlie Munger. If you know, it kind of talks about him being a scrappy investor when he first met him. But overall, they got to the point where they really had a shift. When you look at Apple, it is really the undisputed leader when it comes to smartphones, when it comes to consumer electronics, wearable technology, and a ton of wide range of service. Also in the tech industry, has very high margins, Bank of America, of course, is the second largest bank behind JP Morgan Chase. American Express is the top credit card company along with MasterCard and Visa, which Berkshire also owns a big stake in. And Coca-Cola is probably one of the biggest success stories that we have seen with this. Now, of course, Chevron is one of the major US-based oil companies behind ExxonMobil. And you'll notice most of these, he holds the top tier or really the second tier when it comes to everything in here. So when you start looking at the reward to shareholders, this is where it gets kind of interesting because the majority of these companies have raised or boosted their dividends through the years when you're holding them a multitude of years. Coke and Chevron have primarily focused on growing their dividend. Now, their share prices might not have increased as much, but the increase in dividend has been exponentially. Both have increased their payout more than 50% in 10 years. So think about that for a moment. We're in 2024. You're looking at 2014. In a 10-year time frame, they have raised their dividends that they're paying out 50%. Now remember, that is absolutely a boatload of dividends that they're paying back. In addition, a lot of companies have been doing buybacks as of recently. As the inflation starts going up, consumer price index starts going up, these companies are making money. They're doing some of these buybacks. And of course, some of these are in record numbers. We have even seen this from Apple. We've seen it from a couple different companies that there is a pretty big buyback. And with the buyback, of course, is going to increase the price itself for the shares that you're holding. Now, again, for me personally, I do not buy individual stocks. I know a lot of people that do, but I stick more to ETFs. That is really where I'm in, but it's very undoubtable when you look at this on how much growth you can get by investing in individual stocks. So it's definitely worth looking into it. Now, Berkshire also put a letter out in 2023 to shareholders praising the leadership of some of these oil and natural gas companies and the specific play and the role that they have within the companies themselves. Now, of course, excellent values worth considering now. When you start looking at the price and earnings ratio, this is where it gets a little scary. When you start looking at some of these major tech companies, are they really worth it? So a lot of people are looking at Nvidia and saying, when is it overvalued? At what point is this stock going to be not worth what it's essentially building or what we're having because of the price and earnings ratio? Now, of course, on the other side of this, we've seen it go really quickly with Tesla, which they were one of the top performing companies. Then they were in the top 10. Now I don't even believe at this point they're in the top 10. I believe Microsoft did knock them out of the top 10 just because their stock has continued to decline. Now, when you start looking at Tesla, breaking it down really to bare bolts of what the company does, the company is an automaker. As much as we want to look at technology, as much as we want to look at the EV, they are a car company that is not selling a lot of cars, which of course they were really, and a lot of people have said they were kind of overtraded, that it wasn't worth buying it at the current price. And since then, we have seen a very big drop in that stock. And of course, with some of the slow growth that we're seeing out of China, it is the exact same thing where a lot of Teslas are really built there. We have seen this kind of going down. So what is the best way to do this? It is really sticking to the process. When we start getting into what do you want to do? What's the 1 year, 3 year, 5 year, 10-year plan? How are you going to build it? And what are you looking for? Like I said, personally, for me, it is not about holding these individual stocks. But when you look at Apple, Chevron, Oxy, there's a lot of them when you're putting them in your portfolio, even as a very small percentage, they have been paying out dividends for a multitude of years, some of them 20, 50 plus years, which is kind of crazy to think when you're looking for strategies and looking at companies. What are the basis and what are the values? That's really, I think a big part of what people are missing with companies. What does a company itself actually stand for? As an individual investor, you're investing in an individual company, regardless of what the company does or what sector it is in. Buying things again that you use, that you have kind of in your day-to-day, makes a really big difference. Now we know, of course, when it comes to Berkshire Hathaway, they keep a massive amount of cash. We have seen this for an incredible amount of time. That way, if anything comes up or a company looks like it's going to be a good valuation, they can go ahead and buy a huge, massive stake. And we're talking millions, multiple millions, possibly even billions of dollars of stakes into that company or stake into that company, making it really big. Now, of course, when you're looking at the high risk tolerance, this is where it gets a little costly when you look at individual stocks. You have to make sure your risk assessment essentially aligns with exactly what you're putting your money into and you're doing your research. That is one thing that I cannot stress enough. When it comes to doing your own research, make sure you're looking at your ETFs, you're looking at your stocks, you're looking at your bonds, you're looking at your crypto. Make sure you know what you're buying. And I know this goes back to Dave Ramsey. Really, if you don't know what you're investing in, rule number one, you should not be investing in it at all. If you're investing, you don't know what it is, you're going to get burned. A majority of people who put their money in crypto lost money. A lot of people who put their money into REITs lost money. A lot of people that put their money in bonds didn't lose money, but didn't really see a big growth factor. So you have to be really careful when it comes to investing in these individuals. But overall, when it comes to Warren Buffett and when it comes to this $370 billion portfolio, that is made up of literally 6 dividend stocks, make up almost 80% of its entirety, and they continue to pay stocks on a very regular basis and continue to increase the stock position, meaning they are paying more dividends time after time after time. So, all right, guys, definitely anytime I see Warren Buffett's name, have to definitely check out any article, any news, anything about them. So let me know what you guys think of Warren Buffett, and I'll catch you in the next video.